everyone, welcome to this special series, The New Normal. During the course of this series, we talk to experts to understand what's going on in the mutual fund space and how our investors and the consumers taking to this new normal. Joining me today is a very special guest, Mr. D.P. Singh, who's a mutual fund industry veteran. He's been a banker in the past. He's the Executive Director at SBI Mutual Fund. Thank you very much, Mr. Singh, for joining me here today on the new normal. You know, you've had a very multi-pronged strategy in the sense you've obviously, like all the other AMCs, been engaging with individual financial advisors, but you've also got the State Bank of India brand and the branch network. Has that contributed significantly to the growth, and where has the growth come from?
So obviously, for any financial product, everything happens with the trust, and the kind of trust this brand enjoys definitely gives us a lot of comfort, and it gives us so much benefit that when we reach out to somebody with the new normal, with the new product or with the new concept, first thing is ice break has already happened because it's coming from the house of State Bank of India. So definitely they'll be talking about something positive only. We don't have to sell the brand, we have to talk about the concept only. For that matter, yes, it's very, very important, and we are fortunate to have such a strong brand with us, which gives us a lot of leeway.
The growth that you are seeing coming, is it coming more from the smaller towns and centers, or are you seeing it more still from the metros?
No, we are saying it's equal. It's coming from metros also, because metro base is already quite big. If we look at the percentage terms and absolute terms, metros and big centers are contributing a significant amount, but a very, very healthy growth is coming from the smaller towns also. This has happened not only because the concept has reached there, this has happened because of the technological upgradation which has happened. Now, selling a product or buying a product, the geography is not a hindrance at all. The way somebody has to do it sitting in Mumbai, the same way it can be done from Leh. Only thing is, if you are having a good bandwidth, if you are having a good network, it's going to take the same time. If it's going to take 2 minutes in Bombay, it's going to take the same 2 minutes if you are sitting anywhere in the country or even abroad. So that has definitely brought the distances and the geographical limitations to the least possible things. Only thing is the quality of advisors, the quality of people who are selling these products is different. Obviously, because of the economic conditions, because the volumes are less, the economic viability of creating a significant, a critical number is very, very difficult in a small town. But still, the people who are working in B30 towns or so-called tier 2 towns, they are doing a great job. And we have seen a significant shift from total risk assets to less risky assets also. So we have seen that which was happening only debt schemes or debt funds were being sold only in bigger towns or to the corporates. Now they are finding their place in the portfolios of individuals as well as in the portfolios of the investors from the smaller towns and B30 towns.
In fact, I was going to ask you about the whole debt piece. You've been very passionate about talking not just about equity, because mutual funds, when we talk about it, is perceived as an equity product. But you've been talking about debt, and I presume that comes from your banking hat. Do you see a change in people's attitude where they are, especially when we are in a falling rate kind of a scenario today? You're taxed at your income level, whatever bracket you're in. The rates are just about a little over 6% for an FD. It's less than that. It's 3.5–4% for a savings account. There's no way you can beat inflation that way. But are you seeing a shift of people saying that, look, I'm moving from a guaranteed product to a liquid fund or an ultra short-term kind of a fund which a mutual fund offers?
No, I'll explain it in a different manner. You picked up a very, very significant point, that mutual fund being perceived as equities only. You are absolutely right, but when we are saying this program is new normal, I would like to explain that both banks and mutual funds are in the business of managing surplus money of people. People, the money which they are not spending, discretionary or non-discretionary, whatever they are saving, they are putting in somewhere where they get as much as possible as return. And this return could be in the shape of interest, or this could be in the shape of capital gains. So the mutual fund product as a new norm is a quasi-banking product. And people are graduating from banking products to mutual fund products. Why so? The question is today, earlier there was a norm, if you have 2 crore rupees, if you have 5 crore rupees, go to a bank and bargain for a higher rate of interest. The tables have turned today. If you are having a higher amount and you go to a bank, bank will offer you lesser rate of interest because banks have their own limitations. They can't afford to have the gap between assets and liabilities because what happens in a bank, if you are accepting a deposit at a particular rate of interest, tomorrow when the rates go down, you are committed to that rate of interest, but your lending will happen at a lower rate. So what happens? There's a asset liability mismatch. So the margins for the banks come down. Now, for the last, I will say, 5 to 7 years, banks have come to a conclusion that we will not accept big ticket, high cost deposits. So in such a scenario, I'm not talking about the big ticket. If you want to earn little more than what is being offered by bank deposit, what will you do? You don't have any choice but to go to mutual fund because it's a golden rule for getting anything higher. You have to take little higher risks. So that depends how you move forward. Earlier in bank, people used to talk about if you want absolutely safe and liquid, you have to put money in savings fund account. You want to put in a disciplined way. It's RD, it's saving, RD, then FDR. So that used to be saving, RD, and FD. Now actually the curve has changed and the curve is same. It starts with savings bank account, it goes to RD, it goes to FD, but then it moves to liquid fund. That is the next term. Liquid fund, ultra short term, medium term. Then as a replica of RD, it's SIP. As a replica of FDR, it's FMP. So these things give you little higher return than the bank deposits at any point in time. Only thing is we have to see for what time period, for what purpose we are doing it. With taxation, there are taxation benefits. Capital gains are taxed in a preferred manner, whereas the interest income is as good as when it's as per your bracket, income bracket. So that's how it's happening. So I am absolutely clear that this mutual fund product is definitely a new normal. We have a big campaign going on through Association of Mutual Funds in India, which says mutual fund sahi hai. But that mutual fund sahi hai has to be decoded. We have to talk about it, how it is better, how it is sahi hai. That is something very, very important, and this is a very, very blurred line between a bank deposit and mutual funds and some of the products. And then once you have the sufficient savings in the products where you are getting a policy rate plus and inflation beating returns, then some portion of your surplus you definitely put in the wealth creation. And there are definitely experts who can tell you how the scenarios look like. They look at the track record and then they go forward.
Mr. Singh, while our generation was more risk averse and people preferred to keep their money in either, a government-backed savings scheme or a bank, is the younger generation, according to you, willing to take more risk? Are you seeing a lot of young people coming towards mutual funds and exploring both equity and debt through the mutual fund route?
Yes, definitely. See, we people were in the generation when we were managing the money and without taking any risk. And then became the intermediate generation after the reforms, whose finances and whose surplus money was being managed by their parents. But now when you are talking about millennials, they are taking care of their own money. And they are definitely bringing more money into the risky assets or capital market assets and equity assets.
Been a pleasure talking to you. Thank you very much, Mr. Singh, for joining us here today. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.